What can a 200-year-old fairy tale teach us about being better long-term investors? Today we're going to talk about Rip Van Winkle. We're going to be talking about his 20-year nap, and we're going to be talking about what his experience would be like if he were an investor today. Okay, so let's kick off. The story of Rip Van Winkle from roughly the early 1800s. He goes to sleep after he has a little too much to drink. He wakes up 20 years later and he sees everything is different. He didn't realize it. Okay, so if Rip Van Winkle were an investor and he would have invested his money, had a little bit too much to drink, and woke up 20 years later, what are the chances he would have made money in the market? Now, we don't have history on the S&P 500 going back to the 1800s, but let's look back over the last 100 years, so going back to the early 1900s. What would Mr. Van Winkle see when he logged into his statement? So I want to look at this chart here. Now, as you can see over on the left-hand side, you can say, okay, if I looked at my statement every 6 months, I'd have roughly a 60% chance of being pleasantly surprised and seeing a positive in the market. And as you move over to the right, all the way to 20 years, that percentage goes from 62 all the way up to 100. And so what does that mean? It means the longer you wait to look, the more likely you are to see positive returns in your portfolio. And so Mr. Van Winkle, he slept for 20 years. And at any given time over the last 100 years, no matter when he went to sleep, if he checked his statement 20 years later, he would have been positive. He would have made money. Even as you can see, up to about 15 years is when that number goes to 100%. Keep in mind, this has nothing to do with me saying the future means there's a 100% chance of gains or anything like that. We're just looking back at the last 100 years and saying what has happened in the past. It can give us some indications of the future. And so even if it's not 100%, after about 7 years, you start moving into the 90s and the high 90% of having a positive experience in the market. And so what's the takeaway here for long-term investors? Well, a lot of this is you get to choose your experience when it comes to, do you want to see a positive return or not? The longer you wait to look at your portfolio, the higher the chance of seeing a positive return. And now I know that that can sound a little wild for some. Lots of times we want to check it every morning or check it every statement or whatever that might be. Just realize these are your odds. So if you're looking at your statement, you're almost at a coin toss that comes out every month. You're almost at a coin toss. Is it going to be positive or is it going to be negative? Now, what does that have to do with your long-term goals, which are most likely going to be decades in the future? Even if you're getting ready for retirement, most people starting retirement are going to be retired for 20, 30 years. And so we are thinking about long-term measurements here. And so Rip Van Winkle, waking up every 20 years, he didn't even know the markets went down. He didn't even know the markets had ever gone down because all he saw was, I've always gotten more than I started with. Market seems pretty smooth. So you're choosing your experience based on how often you want to look at it. But it would be naive to say, just never look at your portfolio, and then of course it'll go up eventually. Because the reality of it is, it's not 100% all the time. And if you are retired or you need money, you don't want to be selling something when it's down, even if it's not a high likelihood. And so there are still periods, whether it's from 6 months to those 15 years, where the market has historically been down over that period of time. And so when you're looking at your plan, you want to make sure that you do have a safe bucket that you can go to allow for, while it's not the majority of the time, it's a minority that gets a much, much smaller minority as time goes on, but it is still a chance. And so while the market does go up over time, in particular over extended periods of time, the numbers get pretty high, right at 100%. In the shorter term, just make sure you have somewhere to go if you're needing funds, whether it's for kids' education, a home purchase, retirement, whatever. While the odds in the market are in your favor, they're not 100% early. So know where you can get access to funds, right? And know that over the long haul, right, your chances are pretty good. And if you wanted to act like Rip Van Winkle, check your statement every 20 years. Your chances are pretty great. I hope you found this helpful. And as always, thanks for investing your time with the Personal CFO.